All right, so today I wanted to talk about this tweet I seen from Brian Feroldi. This is something I've talked about quite a bit, but I wanted to talk about more because this is one of the most important aspects, if not the most important aspect, when it comes to investing in stocks, right? And again, this is a chart that you're going to have to visualize to see, so you're going to have to see it. And again, he points to this chart is, again, the stock price is going to bounce around a lot, right? The stock price is going to go up, it's going to go down, it's going to go up, it's going to go down. But again, what you want to pay attention to is the underlying business behind the stock. Is the underlying business behind the stock doing good? Is it doing bad, right? Because if all the key metrics are growing over time, but the stock price is going down, well, you should be even more interested in the stock, not less. Now again, you also need to keep in mind, is there something else going on, right? Was there like a massive scandal? Are they taking on excessive debt? Like, you need to keep in mind stuff like that as well. But if the underlying business is doing well and there's no clear and obvious red flags, but the stock price is going down, you should be even more bullish on the stock because you're getting a good company at a discount, right? You're getting a good company at a discount. And again, if you want to visualize this, I have a stock that I've talked about before that I like, QLYS, Qualays. And what I mean by this is you look at metrics, right? Free cash flow is probably one of the most important ones. Look at this free cash flow growth, consistent growth every single year going back about a decade, right? It's grown like 10x over the last decade, right? So again, consistent growth. Let's look at, again, they haven't taken on any debt in the last decade, right? Zero debt. They're buying back shares going back to the last 6 years, right? So each of the last 6 years they've bought back shares. So again, this checks almost every box in my opinion, right? If we look at the balance sheet, let's pull that up. Their assets are clearly more than their liabilities, right? They have a good amount of cash on hand. If we look at the metrics, let's look at the metrics here. They're consistently becoming more profitable over time, right? If we look at let's look at the operating margin here, or even the operating cash flow. But if we look at the operating margin, again, this is a number that's gone up over time, right? It's consistently gone up over time. Looks like in 2021 it went down a little bit, but again, a 21% operating margin is still a good operating margin, right? So again, when he says and when I say you have to focus on the business, that's what I mean, right? Because again, if we look at the stock price here, let's look at the stock price. Go back 5 years, say. Again, look at this. There's been some massive peaks and troughs here, right? Look at this one in 2021. It was down, 35% in a matter of 2 or 3 months. It looks like, right? So that's what I mean by that, right? That's what I mean by that is that, again, this stock it actually looks fairly more volatile than I thought it was, but that's kind of just proves the point, right? That again, you're worried about the underlying business, right? When you see these massive drop-offs, right? When you see these massive drop-offs, but you see the business consistently growing over time, that should make you more interested and not less. And this is a big mistake that a lot of people make, is that they'll see a stock price go down and they'll think that it makes it bad for whatever reason. But you also need to keep in mind too that some stocks are like trying to catch a falling knife, right? Some stocks are that way, which is why you need to keep an eye on the financials, right? You need to keep an eye, again, what does their balance sheet look like, right? If they have more liabilities than assets, that's going to, unless they're a company that relies on taking on debt to grow, a utility or something like that, like or a REIT or something like that. But again, if they're like a software company or something like that, and they have crazy amounts of debt, yeah, you really don't want it. To me, it's a big red flag, at least. And like I say, you want that cash flow growing consistently over time. You want a strong operating margin, right? Because a strong operating margin means they're a very profitable business, right? You want to keep in mind, are they perpetually issuing shares? Because a lot of these low quality companies, the way that they grow is by taking on crazy amounts of debt or by perpetually issuing shares, right? Because if a company is increasing their share count by 5% a year, that's dilution to you, the existing shareholder, right? So not only do you want them not to be issuing shares, preferably you want them to be buying back shares, because that's value that you're going to get regardless of what the existing share price does, right? So again, when he says this is a very, very important visual, right? This is a very important visual. And again, I have learned this lesson both the easy way and the hard way, right? When I first got into things, I learned this lesson the hard way. Now I have, a handful of companies that I keep a close eye on, and if they go below a certain price or existing price to free cash flow or whatever, I'm going to be all over it, right? I'm going to be all over it because, again, you are getting a good business at a discount, right? Again, the way to be successful is to buy good businesses at a discount. That is the easiest way to be successful. Now, again, to do that, you have to know what to look for, and you have to be patient, right? Again, you can buy, again, you buy a Tesla or an Nvidia or one of these companies. Yeah, they're good companies, but you're paying crazy valuations for them, right? So again, you have to buy good companies at a good price. That's the way to be the most successful over time, right? And again, when people say, "Oh yeah, I bought Nvidia with a, and made these good returns," it's like, okay, well, yeah, it's not like that doesn't happen. But when people cite, making some massive return over a 6-month period as the reason why they're a good investor, again, I would immediately distrust them, because it's not what makes a good investor. What makes a good investor is being able to get good returns consistently over time. And you're not going to get the returns that you've gotten from Nvidia over the last 6 months to a year consistently. It's just not going to happen, right? And again, for every 200-300% pump you get out of these companies, a lot of these guys also are down 50, 60, 70, 80% in some of these, the Beyond Meats and of the world, right? So you also have to keep that in mind, right? So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.